Hello, everyone. Welcome yet again to another episode of the Sustainability and Climate Podcast. And I remain your host, Oluwatobi Aigbogun. And as usual, no leave, no transfer. I have the one and only Labake. Hi, Labake. How are you?
Hi, everybody. I am well, thank you. I'm very excited. Why? Because it's summertime. Yes.
Interesting. What have you been up to? What have you been up to, Labake?
I haven't been up to too much other than work
Oh, yeah?
in the last couple of weeks. However, my summer is officially about to begin. I have booked time off this summer. So it's not till August. So
I'm
I'm
not, je-
I'm
I'm not,
I'm
I'm not jealous anyway, so it's all right.
you can't be jealous, okay? You've had quite a few holidays this year. Don't let me rush you out on the podcast. Um,
Fair
but I
enough.
finally booked some time off, yeah,
Yeah.
in August. I'm really excited for it. I feel like my summer is also starting.
Mm.
I have a couple of travels planned.
Yeah.
Um, yeah, not all fun, not all holiday, kind of work squeezed in there. But just a little bit of a change of environment, change of pace. I'm really excited about that. But yeah,
Mm.
it's just been work, adulting, all of that good stuff. Yeah. How about you? How's it been?
I've been all right.
Yeah.
Good, busy with work. A lot of things happening this summer, and so I have a lot of things I'm doing, and so I'm just like,
Yeah.
okay, keep up. But yeah, but it's
Keep it
been good.
pushing. I see that you're also wearing a blazer, which means London is no longer going through a heat
Yes,
wave.
yes, yes. Thank
Congratulations.
you, thank you, thank you. It's no longer as hot as before. But yeah,
Mhm.
I've been good.
Yeah.
Enjoying the season, enjoying the weather. This is August is usually a very chilled month for me. So, but again, with a lot of family activities planned. But yeah, I'm enjoying it. I can't complain.
That's awesome. That's good to hear. We hope our audience is doing well as well and enjoying the summer. Would love to hear from you guys. Send us a message. We're on Instagram. We are also looking at comments on the podcast.
Yeah,
And we're also on LinkedIn. So send us a message about what you're doing with your summer, what you've been working on. Would love to hear that and also share some of those from you guys as well.
yeah. And also,
Um,
what conference are you attending this summer? Because there's a lot
Good
of
one.
conferences going on in terms of
Yeah.
sustainability, ESG, climate,
Yeah.
and yeah. Just let us know what conference, and maybe you may see me there. I can't say of Labake, but yeah, you're likely to see me there. But yeah.
Okay. Okay. If you see Toby, please take a picture with him and send it to me.
Nice, nice, nice,
Yeah.
nice. All
Yeah.
right, so we'll just go straight into today's episode.
Yeah.
We have a very interesting guest with a very strong profile as our guest on the podcast, and Labake has given me the privilege to introduce our guest today. And so our guest today on the podcast is Cara Williams. Cara is a senior partner um, and also a global ESG and sustainability leader for Mesa, located in London. Yes, London winning. Cara leads the program of work to articulate and amplify our organization's ESG value proposition and positioning. Also, Cara drives strategy for Messa's multinational and wealth management clients to deliver the best of its broad wealth solutions. She has over 25 years of experience in the investment industry. Cara began at Masters Investment Consulting Business as the global COO in April 2005, and she began her career in finance as a financial advisor. So yeah, we are so excited to have Cara on the podcast, and I am sure that today's conversation will be inspiring, enlightening, and all things that comes with the Sustainability of Climate podcast as usual. So guys, sit back, relax, as we welcome on the podcast, Cara Williams. All right, guys, as we mentioned, we have on the podcast today Cara Williams. Cara, thank you so much for coming on the podcast. We are so excited and honored to have you on the podcast today.
Well, thank you for including me. I'm really looking forward to actually getting to know you guys better.
All right, thank you. Before we dive into the question, I love to ask this question How did you find yourself in this space?
So I've been with Mercer for a very long time, and had very different roles. And we on the investment side started a responsible investment team about 25 years ago. I've been with Mercer about 21 years. So I was always heavily involved with them as they grew their mission, and we can talk a little bit about how that's evolved over time. But we were at the forefront. So I'd say when it came to the environmental aspect, I was always involved via Mercer. Then, DEI has always been something that's been near and dear to my heart. I went to University of Michigan. They did some alumni courses to help educate us on DEI, diversity and inclusion, and the value that brings to organizations. Was given a coach, was given, sort of ways that I could improve my own awareness and understanding. And so these were things that I just sort of talked about within the organization on a regular basis. And then was very luckily asked to take the lead across all of Mercer to look at sustainability and what we do as an organization for our own employees as a value proposition, but also in our investment thesis and how we work with clients more broadly.
Just like you mentioned, you spent over 2 decades in the investment space. And so my question to you is, how has the industry relationship with the ESG evolved over that time? And where do you see the greatest momentum or resistance today?
Yeah, so 25 years ago, it was pretty much unheard of.
Yeah.
And we were using the term responsible investment back then. And really at least for Mercer, what we were doing was we were assessing asset managers on their integration, looking at how much they were thinking about environmental, social, and governance issues when they were choosing whether or not to allocate and invest in organizations. And so that's how we started, and our engagement with clients back then was relatively conservative. We didn't necessarily mention the rating, and we did provide a rating to every asset manager to their strategies, and we didn't really bring it up unless a client kind of mentioned it and we knew that was something they were interested in. That evolved after about 4 or 5 years. So this is about 20 years ago, 19 years ago, where we really started to say, you know what, we should at least let the clients know, every client know what the ESG rating is. So we gave a investment due diligence rating, and then next to that we gave an ESG rating, sort of a freestanding rating, and the two didn't necessarily impact the other. And again, as time evolved, we decided to be a little bit more forthright, and we always included ESG ratings with every proposal that we gave to clients. And then as time went on, we probably became a little bit more forthright in expressing the importance of the ESG integration. As you can imagine, ESG has become much more politicized, certainly over the last few years, but we certainly found that the vast majority of clients around the globe understood the value of taking all aspects of all available financial information when making investment decisions. They understood the importance of that, right? So it didn't matter where they were placed. They all said, no, we want to know if an investment is going to be impacted by environmental issues, climate change, that suddenly causes shutdown of companies, or that employees can't get to work, or you look at the social side, maybe employees are exposed to unhealthy conditions so that they can't produce, right? So if you think about it in the most sort of revenue and return way, and kind of take any of the emotion out of it, I think clients understood that environmental, social, and governance factors were important on to whether about whether or not an investment was going to produce a good return. I think as time has gone on, then I think the asset management industry did a little bit of a disservice by starting to launch what they were calling ESG funds, which is a misnomer, right? That doesn't really mean anything, because as you know, under environmental, under social, and under governance, there are so many different factors. It's impossible to be a true ESG fund. I mean, what does that really mean? So I think you started to see the returns and results being publicized, and if there were any kind of shortfalls and they were underperforming compared to non-ESG funds, it kind of didn't make much sense. And if anything, it was a really easy way to start to say, well, ESG is bad, right? Because you are underperforming. But again, ESG doesn't necessarily mean exclusion. It doesn't mean that you aren't investing in certain industries. You very well could still be investing in certain industries that are, the gray and the brown and industries that aren't necessarily good, but you could still invest it because you realize that an organization, a company is actually on a journey to maybe decarbonize or at least decrease their carbonizing. And I think that wasn't understood. And again, I think that was a bit of a, it's certainly an unfortunate situation because that led to sort of this negative view. You asked about geographically, obviously, as you know, it varies very much around the globe, what the views are on ESG. And I am using the term ESG more than sustainability because I think sustainability is a little bit more accepted in most circles. But ESG, in the United States has definitely gotten a very negative rap as to what it is and what it isn't. And again, I really feel it's about a misunderstanding as to what it is and what it isn't. And you see in the Middle East, the term ESG is still very, very common. We're still seeing a lot of searches and RFPs coming to us that are specifically using those three letters. We're still seeing that coming out of Africa and on parts of Asia as well. So the world is definitely splitting a little bit when it comes to its views on things like ESG. Sustainability, like I said, I think is a little bit more acceptable because it may be less specific, right? That it doesn't necessarily allude to things that that organizations may be uncomfortable with. But it's been I'd say the last 18 months have been really fast changing. And you see a lot of organizations trying to realign and try to assess, exactly where they are on the spectrum, and which isn't necessarily a bad thing, that part. But yeah, anyway, so long answer, but that was a very meaty question, so I apologize for that.
Somehow all our questions seem to be like that. I think we enjoy multiple questions in one, so that's totally fine. As you said, a lot of firms are still kind of navigating ESG through the lens of risk and regulation. How do you at Mercer kind of guide clients to move beyond compliance towards more strategies that deliver kind of tangible environmental and social impact?
Yeah, so because we have two aspects in the organization, right? We have our wealth business, which is on the investment side, but we also have HR consulting, and so our health and career business are the world's largest HR consultants, which gives us a really interesting perspective. So when we work with clients, we can kind of pull in the importance of the people aspect into when they're making their investments. I think you mentioned the risk piece. I think that is where most organizations have been able to position their keeping an eye on ESG in a way that is not politicized. So I'm quite grateful for the risk position because at least I think where there's a lot of debate is on the opportunity, and that's where there's a lot of pushback. And again, like I said, if you see lower returns compared to certain funds, people automatically say, well, you're not paying attention to your fiduciary duty because you are taking these things into account, which is, as we know, is not necessarily the case. But I think the risk side of it is actually an important side because it has allowed organizations to continue on this journey, to continue to focus on all aspects of sustainability, which do entail environmental and social, as well as governance side. So I do think that's actually, like I said, I think it's an important and positive aspect that has allowed organizations to continue to look at these things. As far as strategy goes, again, we do see a lot of organizations who double down, right? Who have just said, either the environmental impact depending on the business that they do, or the communities that they operate in, or the employees that they're reliant on. They realize that these are still core components to their success as an organization. And a lot of organizations have learned to articulate that better and more clearly. So that has been part of the strategy, is saying, okay, let's not look at all of sustainability because we can't control all the levers. These aren't all necessarily in our control. Let's look at the ones that we can potentially control. So the aspects of the environment that we are reliant on and the aspects of the environment that we have an impact on, thus making us reliant on them. And then the same exercise when it comes to people and communities. So I do think that you do see a lot of organizations getting smarter and thinking more clearly about how these aspects do impact their business for shareholder value, which is ultimately really what their mission is sort of originally meant to be.
Now let's bring diversity into the conversation, because you've long championed diversity as part of the ESG. How do you think investors or companies are beginning to integrate equity and inclusion metrics into their sustainability strategies, and what more needs to be done from your point of view?
Yeah, so again, this is where I think regional differences are important. In Europe, CSRD, while we could all complain about new regulation and reporting requirements, the great thing about CSRD is it is requiring DEI reporting. And as we know, the famous saying, if you don't measure it, you can't manage it. So I think Europe is on a really good path, and I'm really quite grateful for this new regulation that's requiring it. And remember, this is going to impact any organization in the United States that has an operation in Europe. Right? So even if an organization kind of says, "Oh no, we're backing away from measurement," then they're still required. Right? So at least to operate in Europe. So and again, I think if you look at the Middle East, starting with Saudi taking leadership with Vision 2030, diversity, gender diversity in particular, has been incredibly important to them, and they're way ahead of the curve. If I look at where we do a lot of our work, where we're working with organizations on their diversity policies and integration, and actually working with organizations that have large investment portfolios and they want to incorporate diversity into their investment policies, but they also want to make sure that it matches with their own internal policies. So there have been some really interesting engagements, again, in the Middle East around diversity in particular. I'd say in the United States, obviously, this is, it's become a really sensitive subject. I think you still see asset managers, though, paying attention to diversity and certainly paying attention to, I think, where everyone's moving is towards cognitive diversity and ensuring that people have a wide array of backgrounds. And I think that is, again, it maybe a little bit leads to sort of the risk conversation, and maybe an easier and safer way, right? So to say that you're looking for cognitive diversity as opposed to sort of blatantly obvious diversity. But I do think, again, a number of organizations in the United States have doubled down and have made it very clear that that diversity is a key component to their success, mainly because their customers are diverse. They want to match their customers, and obviously you can't have a leadership and employee base that doesn't match your employee base. So I do think you do see obviously a backing away and increased sensitivity in the main in the United States. And I think if you speak to pretty much any consultant that does do diversity consulting, they will say that they are seeing a slowdown in the United States. But that said, the rest of the world is forging ahead with Europe, Europe and the Middle East certainly taking the lead. So again, I just kind of hope that, and I do expect, the world does swing in pendulum form. So I do expect it to go back to something that's a lot more reasonable. And just, sorry, as a quick aside, I think when you're looking at asset managers, there are very few asset managers out there that when we're talking to them, don't mention what their investment teams look like, and what the diversity, how important the diversity is to their returns. McKinsey just came out with a good study, Diversity Project in the UK. I really encourage you to read that one. Led by Dame Helena Morrissey, that it really focused on the returns, and there is a clear connection between diverse investment teams and positive financial returns. So to turn your back on that, I think as an investment manager, you're probably going to be hard pressed to attract investors.
Okay.
Awesome. I'll definitely look that up. I've taken that down. And it's a really interesting segue. My next question, which is, how do you kind of help your clients then reconcile short-term challenges with short-term market pressures, with long-term ESG and climate goals, particularly in a volatile investment environment?
Yeah. So, I mean, we are a little bit spoiled in that, we are an institutional consultant, right? So, in the main, our clients are institutional investors, which means they have the luxury of long-term investment. That said, we do know there is a level of short-termism when it comes to returns. We've all been trained, to look at the last quarter and to see who's underperforming and who's outperforming. I'd say the first and foremost and the most important thing for us to do is establish the investment policies with clients, right? That is really the first step. You have to understand what the client wants to achieve longer term. And then they need to understand what the potential sacrifices, and the sacrifice may be short-term volatility, depending on obviously what their priorities are. But that's been really the hardest part. So if I say, in the past, certainly when it came to, when ESG was sort of gaining in popularity, and it was about 5-6 years ago, people weren't very specific, and they weren't coming up with very specific goals other than potentially going to, net zero. I think was probably the most common thing that you heard. But otherwise, everybody was kind of all over the place. And what we really needed to sit down with our clients to do is identify what aspects of the environment are they exposed to, and do they really feel that they can manage, and which ones do they really care about. Right. So it's one thing to say that climate change is important to you, but then is it focusing on water or carbon, and is it carbon emission, is it carbon capture? Really establishing a clear strategy as to what you want to do is going to be the most important thing. And then taking into account the people aspect, I think, is added complexity. And then I think the most difficult aspect that we're seeing is the ones who really want to include nature, because nature has been quite difficult to manage, and has been very difficult to report on, sort of success around nature. But I think as soon as a client has been able to identify the things that they care about, establish really what the metrics are going to be, data's gotten a lot better. And I think it's a lot easier now to set that strategy and then to measure it on a regular basis. But that said, short term, absolutely, there's going to be volatility. There is absolutely going to be underperformance. But again, if you have the luxury of being a long-term investor, which the vast majority of our clients are, they're more willing, and they have more of an appetite to accept that. I mean, just like, if you look at private markets, right? So private markets obviously do much better with the institutional world as well, because they're more comfortable with the lockups. It changes your mentality, and it changes your capability on how willing you are to just kind of take certain types of, I guess, potentially risks, but also as the upside, the opportunities. It's just trying to avoid paying attention, sort of looking every week to week or even day to day.
Awesome. So you mentioned the role of asset managers earlier, and we know that many asset managers and institutional investors have made net zero pledges, right? And what are the biggest operational, or we'll say cultural hurdles they face in terms of making those commitments meaningful and measurable?
Yeah, I mean, I think everybody got very excited to make net zero commitments, and I think a lot of them were probably too aggressive and too aspirational. I think what we see more of is a lot more leadership kind of saying, okay, the targets we've set are beyond the time that I'll even retire. So what do the next 5 years look like? What do the next 10 years look like? I think SBTI, so science-based targets, have become much more concrete. And that's where you're seeing a lot of organizations commit to SBTI targets, which are much more reasonable and much more achievable. And certainly much more measurable and reportable. So, I think the initial gung-hoism has faded, and I think people now realize the seriousness of this. And if you are going to commit, then you've got to commit. And again, you're seeing more organizations that are starting to do it at a strategy by strategy level rather than at the organization level. I think they've just realized that, again, client appetite is very different. And if you're going to manage money for one client in a certain region, they were probably going to want something quite different than a client in a different region. So you're seeing a lot more asset managers kind of bifurcating their businesses, but also their strategies getting much more specific to client appetite and what people are looking for. So some strategies don't have targets at all, and that's what clients are seeking. So that's what the clients are getting.
Interesting. So I know your work is kind of based in London, but with a global lens. What ESG or sustainable finance trends are you watching most closely across different regions, particularly in emerging markets or in the global south?
Yeah, so I think the thing that we've been seeing a lot of is, and again, I think it's partially part of the backlash on ESG is the growth of impact. So that's kind of the upside, right? Because impact is very clear. The way it's articulated, exactly what the strategy is trying to achieve. You know what the upside is, and you potentially even know what the returns profile is. There are a lot more investment opportunities now that actually have returns, which is a great thing. You have, the role of, again, data has gotten much better. AI has contributed significantly. So you're seeing a lot more investment into certainly the global south and into emerging markets that wouldn't have been there before, right? It really allows for verification of investment and looking to see if there actually is progress. And once you have that and you have the confidence that you can verify where your money is going and what the positive impact is, you're more willing to continue to support, right, and to invest further. So we're seeing more of that. We're seeing definitely a lot more, I think I've been to four COPs, and we're seeing a lot more collaboration, sort of the private and government coming together to figure out ways to de-risk investments, to make investments more attractive for a broader universe of investors. So I think that the trends are really doing well, particularly for emerging markets and global south. I think people see the opportunity set in those markets. So that's that's kind of the upside as people look around. Anyone particularly interested in making any kind of impact, it's going to be in those markets in particular.
Awesome. It's good to hear.
Yeah. So looking ahead, right, what do you think would define the next era of ESG strategy, and what should leaders start preparing for now to stay ahead of the curve?
Yeah, I mean, I think most of the trends are showing, most of the positive trends are showing themselves to be the things to follow, right? So I genuinely believe in Africa. I think and obviously I think you guys are Nigerian, and what 1 in 4 Africans is Nigerian. So it's incredibly well-educated group where you are not having as much of a brain drain as you used to have. A lot more people coming home. So the investment opportunity is huge, and I do think more people are looking towards Africa for potential opportunity. And Nigeria is obviously going to be top of the list, just given stability and everything else that comes with it. I think the other trend is AI, like I mentioned earlier. I think, the ability to use drones to do planting, to assess whether or not people are getting to markets, to assess whether or not, do air quality tests. I think the use of drones and AI is going to be really huge. Carbon capture, I think, is getting much more innovative, like on a daily basis, and the fact that it's not just a package it up and stick it into the earth, but who else could use it? If a soda maker can take that carbon and start making soda, then and sell it, that's you start looking at ways that you can start making money off of some of the bad things that we're emitting into the air. I think the circular economy, I think, is going to be a really interesting area. I think the world is really trying to figure out where, if you made it and you packaged it, you need to figure out how to get it back. And there's lots of ways to make money along that path. Yeah. So I think organizations and you see a lot of really interesting startups and venture opportunities in the circular economy area as well. I don't know. I mean, I guess I'm probably still I'm really positive about overall opportunity. Like I said earlier, I do think I said this recently somewhere. Something went wrong when the way that I think diversity was presented. I think we need to look at how it was discussed, because somehow the majority somehow felt alienated and felt suddenly that they're a minority, so they've lashed out. And we need to figure out how to bring diversity back into the conversation in a way that isn't off-putting, and get people to obviously understand the sheer value and the common sense of it. And again, bring it back to shareholders, right? If it's about making money, that's the way to make more money, right? To ensure that you've got a diverse workforce, make sure your communities are diverse. Anyway, so I think there's a lot of positivity, and there's a lot that, again, the pendulum. I expect the pendulum to swing back. In my view, it can't stay where it is, and I think there's too much, like I said, too much positive happening. You look at the Middle East and Asia and Africa, and you look at Europe. I think there's a common sense movement that's happening, and I think we'll get there. And like I said, there's lots of great investment opportunities. So I'm positive, but it may take sort of 24, 36 months. Yeah.
Yeah, I love the push for the positive and the pendulum swinging back. I mean, I would love to see that happen sooner rather than later. But yeah, what's one action? So we like to kind of round off the conversations with a call to action. And what's one action that you think every organization, no matter the size, should take today to better align its investment business strategy with long-term sustainability and equity goals? I feel like diversity would be one of the ones that you kind of touch on, but yeah.
Yeah. I mean, I think again, I think the most important thing is, you see, I am so proud of the organizations that have doubled down, right? And I think they've been really quite vocal about how they're doubling down. And then you have others who are doubling down and maybe just a little bit less vocal about it, committed to their strategies, the strategies they originally set. So to me, my call to action, the way that we work with our clients is, let's figure out exactly what you can commit to, what you can get everyone in your organization, your leadership committed to, and it really comes from the CEO, right? If the CEO doesn't believe it, forget it. It's not going to happen. And then let's focus on those things, right? Let's not try to hit every single possible opportunity, and then articulate around that and action around that, right? So if it is diversity goals, identify what those diversity goals are very, very clearly, very specifically, and be very open about whether or not you're hitting those, and be open with your employees, right? The more your employees know about what you're trying to achieve, either on the environmental, social, or governance side, the more that they're going to help you along. So yeah, I mean, to me, it kind of goes all down to sort of the communication, the articulation, and the communication of what your strategy is.
I love that. Very direct clarity and commitment. Be very clear and specific about what those goals are and commit to it.
Awesome. Thank you so much, Cara. Like I always tell people, this is my favorite part of the show.
It is.
where we close the show, but before that, I just want to say thank you. Thank you for coming on the podcast. For sharing your wisdom with us. It's a true honor to not just listen from you, but also to learn and also to lean into your experience. And I think for me, you've not just offered insights. I see that you've also offered vision. And I just want to remind our listeners and our friends, our families who listen to the podcast that ESG, when it's done right, it's not just about ticking the boxes or us chasing scores. It's about transforming mindset. It's about us shifting systems and also creating value of impact for people on the planet. And I also want to say that your work at your organization, for me, it's a shining example, because one thing about us on the podcast, we are very careful about guests and the organization that they work for. And we can say that the organization is a global platform that its commitment, I see their commitment to long-term value as something that is meaningful and impactful in terms of shaping the next generation of ESG and what the leadership should look like as well. And so I believe that the organization is not just talking about change because I've read your impact report. I see that they're building the foundation of what it should look like, and we celebrate that. And for me, I'm really inspired by that. And to our listeners, I'm sure this episode has definitely stirred something inside of you, and I don't want it to fade away. And when you stop listening to this, I want this to become that fuel that will propel us into taking action in terms of taking that shift that we need to take. And on behalf of Labake and I, because Labake always don't have anything to say when I'm done, I want to also say thank you for coming on the podcast, and we look forward to following up with the things that you do with your organization, and definitely we'll keep cheering you on and supporting the work that you do. So thank you.
My goodness, thank you very much. That was very kind.
All right, so guys, see you on the next episode on the podcast. I remain your favorite, Toby. And Labake, do you have anything you want to say? Let me just give you the space.
Oh my gosh. Thank you so much, Cara, for joining us on the episode. Bye, everyone. See you next time.
All right, bye, guys.